Well, let's get some views then on the global markets. Bhaskar Laxminarayan, Chief Investment Officer and Head of Investment Management Asia, Julius Baer, is now with us on the show. Thank you very much for joining in. So first, give us the emerging market setup. The mojo has been back in the Chinese markets, Hang Seng, since the start of the year. Even the NPC emphasized China tech, AI innovation. But back home in India too, after a rough 5 months, last week at least, the risk sentiment seems to have improved. So what's the, give us the top-down view on emerging market and then break it up country by country.
Well, I think it's going to be a slightly positive year for emerging markets. I wouldn't go as to say it's a very bullish turn of events. One shouldn't take the fact that there is a correction in the US markets to be a positive sign for the rest of the world at this point. In fact, if anything, if the US or the global markets driven by the US starts to drop a bit more, I think that sentiment will sort of pervade all other markets too. So one should be cautious about how one plays this. In terms of emerging markets itself, I think China obviously is in the sweet spot at this point in time. You've got valuations that are very attractive. You've got policy making that's very supportive. And you've got a lot of the bad news behind you, especially when it comes to real estate, which is possibly their real big problem to solve. So I think they're coming to the end of that real estate solving. And if that happens, then you see a further upside. But I would say in a relative sense, yes, China looks a lot more attractive than any other emerging market.
Oh, okay. That's quite an interesting take, Ms. Laxminarayan, because we're always competing, right? So if the US is doing well, then it's a problem for us. Like you're saying, I get that point, that if the US is not doing well, then it's anyway a problem for everyone. And then there's China, which is looking good to you, like you're saying. So where is India sort of in this whole mix? How are we stacking up, given this 16-17% correction at the headline index level and much more in the broader market?
I've always been, and we've as a house been very favorable towards the large caps. And I think now, especially with the correction, I think the large caps are looking quite even better, if anything, right? It's the problem really is, I think, in the small cap, maybe at the bottom end of the mid cap segment, which I think still needs some sort of a reset despite the correction. So when we look at any market, we look at three things, right? We look at obviously the returns that you want to achieve, and then you look at volatility and most importantly, liquidity. Now, if we've seen the first couple of factors play out as far as the small cap is concerned, it's the liquidity part I think will finally play out at some point when nobody wants this segment or more people want to exit than people want to buy this. And I think that's going to be the last leg in the small cap, mid cap space.
Hi, sir. Good morning and good to see you. When I recall when we chatted the last time around, you briefly mentioned there's a possibility the Fed doesn't cut rates by that much, going ahead. And that seems to be what the street as well is coming to terms with in 2025. What are you working with in terms of the Fed action for the remainder of this year? Some say that maybe, in fact, we don't see a cut, while recent soft data points point to the direction that maybe we'll get 25 or 50 basis points. What are you factoring in? And also on the RBI, we've got one rate cut. Out here, the hope is that we get another one in April. Are you in that camp?
So we've always been below the market consensus for the last, I would say, a year plus or more. We've always been behind in terms of expectations on rate cuts. We are of the firm belief that the US is more prone to an inflation risk than to anything else. You could have a policy mistake, you could have a supply chain constraint. This whole tariff talk is a lot of noise, but noise can create some amount of inflation too. So all of those things, I think, mean it's very difficult to have a very, very positive outlook on rate cuts. It's easier to say, stay where you are, and things get really bad. You could even have a rate hike, right? But we're not in that camp. I'm just saying that. So I think betting too much on rate cuts is possibly not the ideal thing to do, which also means that the dollar differential or the rate differential somewhere along the line is going to start again playing in favor of the dollar. So while you're seeing some weakness now, I wouldn't bet on a very prolonged weakness in the dollar.
Okay, all right. That'll be an interesting thing to watch, because it's been whipsawing all over the place between highs of 110, now 104, below 104 actually. So it's been very, very choppy along with many other markets. Thank you very much for the quick view. Much appreciated. Thanks for joining in today.
Thank you. Thank you so much.